What is up? It is Big Chart Trades back with another video. And in this video, I'm going to be showing you guys how to manage your risk. I've been getting a ton of questions about this in my DMs, on comments, my YouTube videos, everywhere. How do you manage your risk? How do you, how are your winning days so much larger than your losing days? How do you set your stops and your take profit? How do you do all this stuff? Well, in this video, I'm going to show you. Now, I'm going to give you a few examples, but by the end of this video, you will completely understand how I manage my risk, because this is probably the most important topic when it comes to trading. If you don't know how to manage your risk, then you're just throwing money at the wall, right? So let me just dive into this example. The easiest way for me to show you is to show you like an actual execution that I would take, and then go ahead and show you, how I set my stop, how I set my take profit. Again, I'm going to do this on multiple occasions, so you will completely understand how. There are a few things that are very important that I'll cover in this video, like sizing, like where to set your stop, where to set your TP. This video is just a complete guide to that. So right here, this is an hourly fair value gap right here. And as you know, I trade the 4-hour PO3. I've explained it in every single video, but there are a few things that are necessary to keep in mind when it comes to managing your risk with this strategy. So just going to mark out an hourly fair value gap right here. Again, this is 9 a.m. to 10 a.m. 4-hour candle is about to open. It hasn't opened yet. And yeah, so I'm just going to do this example and show you how to manage your risk, set your risks, whatever, blah, blah, blah. So we are on this hourly time frame. We see this hourly fair value gap. I'm anticipating this 10 a.m. 4-hour candle to open up, manipulate lower, and then distribute higher, right? Because I'm expecting a bullish candle. So open, low, high, close, right? It manipulates into an hourly or 15-minute PD array, and then it distributes higher and closes. Okay, so that's just what I'm anticipating here. Obviously, this is in replay mode. The point of this video is to just show you how I set my stops and my TPs and how I manage risk. So if you know anything about me, an hourly PD array is aligned with a 5-minute execution, right? If this was a 15-minute PD array, it would be a 1-minute execution. Okay, so we have this hourly PD array. So I'm going to drop down to the 5-minute and look for an execution. Again, I'm waiting for that 10 a.m. candle to open up. Still hasn't. Should be 9:55. Okay, so right, 10 a.m. candles opens up and immediately starts trading lower. Let's see. Okay, so it trades into this gap. Now, a lot of the times, if it's a big range like this, you see how this change in state level. Before I talk about that, let me explain the three things that are necessary in order to take an execution. Right, liquidity sweep. Right, SMT with ES, and then a change in state of delivery, which is my actual entry. So typically, I will look for the liquidity sweep obviously first, because in order for a change in state of delivery to happen, price must sweep liquidity. So as you can see, price swept these lows, and a bullish change in state of delivery is a candle closure above the series of down close candles that swept lows, right? This is a series of down close candles that swept lows. So the change in state would be all the way up here at the 4-hour open, which I don't like. So typically in this scenario, what I would do, and I'm assuming there's some SMT at these lows with ES, right? This is not the point of this video, but so typically what I would do is go to the 15-minute, and I'd look for PD arrays on the 15-minute instead. So immediately I see this 15-minute gap right here. Why do I like this better? Because the 1-minute time frame will give us a better entry than the 5-minute time frame. So I see this PD right here. Again, guys, this is not always the case. Like, you won't always find PD arrays on the 15-minute if there's a PD array on the 1 hour. But since, this is a big range, I assumed that since there was a big fair value gap on the 1 hour time frame, there was going to be a fair value gap on the 15-minute, which there is. So again, if you remember what I said about the executions, the 1-minute is aligned with the 15-minute. So I would drop to the 1-minute. Oh, I can't drop to the 1-minute. That's annoying. Well, whatever. Let's use the hourly gap then. Let me just go back. Let me reverse. Okay. Let's use the hourly gap. So on the 5-minute time frame, this is the change in state of delivery level. Now, I don't like this because this is a lot of risk that I would have to put on, and it is a big range, and the change in state is the 4-hour open. So what I would rather see is price come and sweep these lows. But if that doesn't happen, then I would take, that that change in state up there. So let's see what happens. It looks like, yeah, it looks like we're not going to take those lows. So do we get the change in state there? Remember, change in state has to happen on a candle closure above. This is not a candle closure, so let's see. Nope, still no candle closure. See what happens. Boom, boom, boom. Okay, that's the candle closure. Again, actually, this example is great because it shows you how I manage my risk. So you see how big this range is, right? You see that if I were to go long at the candle closure, this is a 198 point stop, okay? 198 point stop. So if you know anything about points and ticks and whatever, you should know that on a 250K account, I only risk $500 to $800 per trade, okay? $500 to $800 per trade, okay? So if I were to go into this with a mini, okay, a mini is 5 points per tick, okay? So this is 794 ticks. So let me just pull up my calculator here. $5 per tick. Sorry, did I say 5 points per tick? $5 per tick. Okay, so 5 times 794. Okay, so if I went into this with a mini, I would be risking $5 times 794, which is 794 ticks, which is $3,970. So that is obviously an amount of risk that I'm not willing to put on. So what do I do in this scenario if I want to take this trade, right? We have the setup, we have the SMT, we have the liquidity sweep, right? We have the open, low, high, close candle, okay? We're bullish. So what would I want to do for taking this trade? Well, let me just write out. This is a mini, okay? One mini. That is obviously way too much risk. So what about one micro, okay? What about 2 micros? 2 micros, when I say micro, it means MNQ instead of NQ, right? 2 micros is $1 per tick. So if I were to go into this trade with 2 micros, $1 per tick times 794 ticks, that's still $794 of risk that I'm putting on. Now, that is the upper end of my risk assessment. So I wouldn't want to, oh, sorry, this is 2 micros. I wouldn't want to put 2 micros, even 2 micros into this trade because that risk is too much. So what I would do is go in with 1 micro. Why? Because 1 micro is 50 cents per tick times 794 ticks. Okay. How much risk is that? 50 cents times 794. That is 397. Wait, 794. I can just do 794 divided by 2. Sorry, guys. I'm kind of sick. So 397. Okay. 397. So that is way better. Okay. If I were to take this trade, oh my God, you're taking 1 micro on a 250K account. Oh my God, you're sizing so small. Well, guess what? It's still in my risk parameter. Okay. I wouldn't want to take 2 micros because that's on the upper end of my risk. I could, but I don't really like taking on $794 of risk, especially on one 250K account. If this was on a 50K account, this would be completely out of the question. I would be trading 1 micro, right? So 250K account, you could take 2 micros, but I wouldn't like to put that much on. So I would take 1 micro, and that would limit my risk to $397. So even though the stop would go at this protected low, right? Why would the stop go at this low? Because this is a protected low. Why is this a protected low? Because change in state of delivery, since this candle closed above the series of down close candles, right? This is the candle that changed the state of delivery. It makes the low or high that was put in a protected low or a protected high. So price should not get lower than this low. If it does, the trade is invalidated. So this would be the proper, this would be the proper stop loss. Okay, so you see how I'm not really I don't want the trade to be invalidated. I'm not putting my stop up here to mitigate my risk, right? I'm still keeping it at the low. I'm just sizing down. I'm really sizing down. So if I do get stopped out of this trade with this huge range, I'm still only losing $397 as opposed to 3,970, or as opposed to setting my stop up here and price coming down and tapping into whatever, one of these order blocks, right? Price could come down here. It would stop me out and then it would run. You get me? But it would never come down below this low because this is a protected low. And if it does come down below this low, the trade is invalidated anyway. So the proper stop would be that protected low. That's why I want to set my stop at the protected low and just size down instead of, you know, keeping my size large and putting the stop up here, because I still want the trade to play out. So what would I do? I would put the stop there. I would go in with 1 micro. It doesn't matter what, this is like a huge misconception with risk. It doesn't matter what size account you're trading. Okay, obviously, if you're trading a 250K account, you have way more leverage to go when the trade goes in your favor, or when there's a small range, right? Like if the protected low was like all the way up here, right? Like up here, and it was like 11 points of risk, I could size in, right? Since it's 250K account, I could size in with like 2 micros or something, right? There, I mean, 2 minis or 3 minis, right? But since this range is huge, I'm sizing down to 1 micro. Even if this was a 50K account, I would be sizing down to 1 micro, right? But if this was a 50K account and the stop was 11 points, right? I wouldn't be going in with 3 minis because it's a 50K account. I'd probably be going in with 1 mini, right? But you get what I'm saying? Like, the risk shouldn't be dictated by where your stop is. It should be dictated by your sizing. Okay, so it doesn't matter what account size you're trading. Okay, if you're on a 50K, if you're on a 150K, 250K, instead of changing the stop, you would change your size. You get what I'm saying? So obviously for this trade, stop would go there. Obviously this is a huge range and I want 2R. So my TP would be somewhere like up here at these highs. Okay, that's like a 3R trade. But this would be the trade. So let me just map this out, see what happens. Okay, obviously this trade is happening on a larger time frame, so it may take a few minutes to play out here, or if this was a real trade, it would take a long time to play out. But so let's see. See, it didn't stop me out. Okay, there I would have gotten stopped out. See, we traded inside of this hourly gap. Okay, but you see what I mean? Like, obviously this video is not about the example, but it's about the risk. So let me give you guys a different example and show you again. But this is literally how I size down. Charlie, how are your losers so much smaller than your winners? Because when my stop is 11 points, I'm putting on size. When my stop is, 130 points, which it rarely is, but in this example it was, right? I'm not like adjusting my stop because I would get stopped out, but I'm sizing down heavy so that I can actually go ahead and support the trade. Let me find a different example for you guys. Okay, so in this example, we have this fair value gap right here, this 4-hour gap. So I want this next candle to obviously push price higher. I want to either like pull back into this gap and push higher or whatever. So let's see. Drop to the hourly, NEP raise. We have this fair value gap. We have this fair value gap, 15-minute time frame. Okay, so we have this 15-minute gap right here. Okay, let's see. Okay, this is, all right, so 15-minute, remember, is aligned with the 1 minute. So we drop down to the 1 minute. I hate when the fair value gaps like go super far. Okay, drop down to the 1 minute. Again, I'm anticipating this candle to come down, manipulate into this gap, and then distribute higher. Let's see what happens. Okay, that is not a good example. Let me find a different example. I'm just trying to show you guys risk, man. Ugh, I hate the replay feature. So annoying. Okay, let's find a candle. No. Let's just do like, this looks like a nice candle right here. Let's do this candle. All right. Again, guys, purpose of this is to show you guys risk, not, you know, not get the trades. Let me drop to the 15-minute. Do we have anything? Well, we really just don't have anything here. No. Okay, I'm just going to go to a change in state of delivery. I'm not going to do all this stuff. Okay. So this is the candle that changed the state of delivery, blah, blah, blah. Okay. I don't care about time. I don't care about like my entry model right now. I'm just showing you guys risk. So, right, change in state level will be right here. Once we get a close above this level, okay, the stop would go at this protected low. So let's see what happens. Obviously we know, right, price closes above it. Okay. So if I were to enter the trade here, okay, the stop would go down here. That's a 35-point stop, right? 142 ticks. Okay. So if I were to go into this with 1 mini, let's do the math again. Okay. 1 mini. If I were to go into this with 1 mini, this is 142 ticks. Remember, $5. Whoops. $5 times 142 ticks. Okay. 142 times 5. Okay, that's $710 of risk. So again, that's on the upper level, right? Remember, I want to risk $500 to $800 per trade. Okay, and I'm on a 250K, right? You got to remember that. So even on a 250K, right, I'm not trying to risk more than $800 per trade. So that's $710. Okay. Remember that I said 1 micro is 50 cents. So like, let's see what 5 micros is. Okay. So 5 micros is $2.50 per tick times 142 ticks. Okay. So 2.5 times 142, right? That's $355 of risk. So I would like that. I could even size up with like, a little bit more. I could size up like with 7 micros. Okay, 7 micros is 7 times $3.50 per tick. So, right, that is $497 of risk. Okay. Again, guys, 500 to 800. So I would go like maybe like 9 micros, which is 9 times 5, $4.5 per tick. So that's like the sweet spot. All right, times 142 equals $639 of risk. So I would take that. $639 of risk. I would take that. That's like right in the middle of the range. But you see what I'm doing? Like everything is sizing and nothing is adjusting my stop, right? I'm not moving my stop up here because the range is too big, right? I'm just sizing differently. Okay. And that's literally how I manage my risk. Okay. So as you can see, price goes ahead and this is horrible PA. Whatever. Price goes ahead and takes the TP. This is not like, again, I'm not trying to show you guys my entry model. I'm not trying to show you guys anything. This whole video is about risk management. So you see how this is pretty non-traditional, right? A lot of traders you see, they say, oh, it's too much risk, adjust your stop. Obviously, when your account size is fairly small, adjusting your stop sort of matters, right? Like if I'm trading options and my account is $500, right? You can't really size down more than like an $150 call because then the calls don't move, right? But since we're trading with futures here and most of us are using 50K accounts, 150K accounts, 250K accounts, whatever, you have that ability to size down. Okay. You don't have to take this trade with like so much size. Okay. And then, so how do you know another thing? Last thing. How do you know when to size up? Well, not only do you know by the setup itself, like if it's an A++ setup, right? If the 10 a.m. opened, it's a clear manipulation to the downside or to the upside right into a 15-minute PD array and you get the change in state, you get everything and it's perfect PA, right? Obviously, it's an A+ setup. You can size into that, okay? But only if your stop isn't so large. So it doesn't really matter like what the setup is. If my stop is 5 points, right, or 6 points, I'm happy to size into the trade with 3 minis because I'm still risking $500 to $800 per trade, right? But if the stop is, 35 points, or like in the last example, 198 points, right? You size down to like 1 micro, right? You size down because sizing is literally the key to risk management. So how are your losing days so much smaller? Well, it's bad PA, but I'm in with 1 micro. So I'm losing $355 instead of, you know, instead of 1,000, right? And when it's an A plus setup, even if the range is large, I'm still sizing down because I'm still not willing to put that much risk on the table. I'm risking $500 to $800 per trade regardless. And that $500 to $800 per trade isn't dictated by where I put my stop. It's dictated by my sizing. So this is literally how I manage my risk every single day. So if this video helped you, I know I've been getting a lot of questions about like risk and stuff. So I just wanted to make this video and clear something up. This is like a nice little session with you guys. Again, the trades were not important here. So I wasn't like finding A plus setups or anything. I just wanted to show you that managing your risk comes down to your sizing and not your stop loss. Okay. So I hope this video helped you. Again, stop is always going at protected lows or protected highs after that change in state. So hope this video helped. If it did, go ahead and subscribe. Leave a comment on something you want me to make a video about. I love making these videos, and yeah, I get a lot of positive feedback in my comments. So it's always great making these videos. But yeah, go follow me on my socials. If you feel like it, you can. Look at this horrible PA, but you can feel like it. If you feel like it, you can. If you don't, have a great day. Good luck with your trading endeavors, and I'll see you guys in the next one. Peace.